Hello, I'm David Cassidy with the market summary for the week ending Friday, the 8th of January. And oh, what a week. While it was a historically depressing week given the scenes of protesters storming Capitol Hill in Washington, coupled with the surging coronavirus cases resulting in tighter lockdown restrictions around the globe, at the same time it was an historically upbeat week for equity markets, and in particular the FTSE 100 index, which had its best start to a new year on record with a gain of 6.39%. Now, the reason why equity markets were able to ignore the protest and the current trajectory for coronavirus infections and deaths was due to the Senate runoff elections in the US state of Georgia. The Democrats won both of the two seats and therefore flipped control of the Senate, meaning that the Democrats now control both houses of Congress and the White House. While a unified Democrat government has both positives and negatives, of most importance in the here and now is the fact that we are now highly likely to see a massive fiscal stimulus package to help the US economy. This is a big positive, especially for the UK equity market, as Joe Biden is proposing to spend nearly $2 trillion on US infrastructure programs, which in turn will require tons of industrial metals such as iron ore and copper, and commodity stocks, in other words miners and oil and gas, which also account for over 20% of the FTSE index, hence why the UK market outperformed its global peers. In fact, this, coupled with the widespread vaccine distribution and an expected economic recovery in 2021, mean that the stars may finally be starting to align for the FTSE 100. Also helping equity market sentiment this week was positive economic data. After the stunning US Institute for Supply Management ISM data we covered in the midweek market update, the US ISM Services Index also came in much stronger than consensus estimates of 54.5, with a reading of 57.2, up from 55.9 in November. November's factory orders also beat estimates of 0.7 of 1% by growing a full 1%, while October's growth was also revised upwards from 1% to 1.3%. Although US employment data showed that 140,000 jobs had been lost during December, October and November's job gains were revised up by a total of 135,000, which meant the unemployment rate was unchanged at 6.7%. Additionally, minutes from the last US Fed monetary policy meeting showed that policymakers don't currently see any inflationary risks. And this, coupled with the fact that the unemployment rate is nearly double of that before the coronavirus outbreak, suggests to us that even with additional fiscal stimulus from Joe Biden, we are a long way from the Fed changing its accommodative monetary policies, which is also very positive for global equity markets. Looking ahead to this week, we have lots of US data, including CPI, the Fed's Beige Book, retail sales, the Empire State Manufacturing Survey, industrial production, the University of Michigan Consumer Sentiment Index, and of course the US weekly jobless claims. Elsewhere, we have UK industrial and manufacturing production, UK GDP for November, Chinese import and export and trade balance data, and Eurozone industrial production.